Good morning and welcome to Stock Market Today. It's Monday, October 15th, 2018, and I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. Stock Market Today brought to you today and every day by Chaikin Analytics in conjunction with StockCharts.com and Stock Charts TV. You should head over to ChaikinAnalytics.com/today to sign up for the Power Feed email to follow along with this show. It hits your inbox in time for you to watch this recording. So I'm going to do something a little bit differently here today rather than recap what happened. I think it's important to kind of walk through some key levels here for the S&P 500 because as volatility has picked up in the market, in our note today, we're highlighting key areas of support and resistance, which investors can use to identify potential turning points for the broader market. On the downside, we've identified this area here in the 2710 to 2720 area as important support. As you can see, it marks the 62% retracement of the move from the late March lows on a closing basis to the September highs on a closing basis. And our view is that if that level gives way, if we break meaningfully below 2710, then the door is open to 2650. And 2650 is important because it's roughly a 10% correction from the highs that we made at the end of September at about 2940. So 10% correction, we're on watch for it. As you can see, the market closed below the 200-day moving average on Thursday. Friday's rally took it back above, and some futures weakness in the futures market has that rally back under pressure and the index back under the 200-day moving average. So those are the important levels to the downside. But what if we do stabilize here? Then we need to start thinking about where the market could potentially run into resistance. I think you have potentially some price-based resistance right here in the 2790 to 2800 area, which kind of makes sense at that round number. Plus, it was roughly support back here in the July-August timeframe, and then again in mid-August. Beyond that, we're identifying 2825, which is a 50% retracement of this leg lower. Should we stabilize here? We do need to start to think about where we could go to the upside and where the potential failure points could be or the resistance points. So right now, support 2710 to 2720. If that gives way, 2650. Resistance 2790 to 2800. And if we break through there, look for 2825. RSI remains oversold. Chaikin money flow indicator does remain bearish. What we're talking about in the note today is how Friday's rally take the S&P back above the 200-day. Small caps nearing support. That's both on an absolute and relative basis. We'll take a look at that one today. 10-year yield remains above the breakout level despite a pullback. Oil pulls back into the trading range. Not that interested in it right now. Futures do point to a lower open. As we turn to the power bars for the major indices, you can see the damage that's been done here. The Dow, remember earlier last week and late the previous week, the Dow had 13 very bullish or bullish stocks, no bearish stocks. Now we're 5-3. S&P 500 saw a slight improvement with that 1.4% rally on Friday, but 44 bulls to 104 bears is certainly skewed to the bearish side. NASDAQ 3-1 to the bears. 21 bearish or very bearish stocks, 7 bullish or very bullish stocks. Small caps, you've seen the carnage that's been done there, and they did underperform on the rally on Friday. Tech had a good day, up 3.2%. According to the Chaikin Power Bar, small cap stocks and large cap stocks are bearish. Major indexes are mixed. Our stock of the day today, if you sign up for that email and you're following along, you'll see that Unisys, ticker symbol UIS, is our stock of the day. Unisys has a very bullish power gauge rating due to very attractive financial metrics, very strong price volume activity, strong earnings performance, and positive expert activity. Stock closed at 1875, up 2.5% on Friday during that relief rally. And you can see here that Unisys has been on a bullish rating for most of this year since February. Shortly thereafter, it begins to outperform the market. So the market and the model are in agreement. Dynamic duo is in gear. Very bullish stock, strong trend, weak industry. But I would note the industry strength and weakness is based on the power bar ratios. And as you can imagine, after the sell-off, a lot of industries are weak. Let's walk through the process here. Deeply oversold and beginning to round higher. Money flow remains bullish. Here's my thinking on Unisys, though. Type of stock you want to own, absolutely. All the kind of tactical aspects in gear, absolutely. But I think in this in-market environment, with increased volatility, you'll get your opportunities. You can pick your spots. I don't think you need to chase a 2.5% rally here. I think if you can get the stock to pull back to the $18 level, for me, that makes more sense. If you're a little bit more aggressive and you want to own Unisys, you like this trend, and you say to yourself, I'm going to own this for a long time, then great. Why quibble over 75 cents? I just think with the volatility in the market, you could probably pick your spots, especially on a name like Unisys, which has a beta that's well above that of the overall market. Our sector tracker now, movement over the last 5 days, nothing is positive. Everything is down over the last 5 days. So the keys here, though, to read the message of the market is you can see the message is defensive positioning. Utilities, staples, real estate, top 3 performers, materials, industrials, financials at the bottom 3. And what's interesting to me is even with solid bank earnings on Friday, financials cannot get out of their own way. Expectations are low for the banks. They jumped over the bar. Stocks still didn't react positively. Bank of America reported this morning they did beat earnings. We'll hear what they have to say. Middle of the road, discretionary healthcare and tech. Really just, though, pronounced weakness across the board. Defensive positioning is the theme right now. Our industry and focus, software and services, and as you can imagine, that has come under heavy pressure, right? These are high beta stocks, high valuation stocks. They were the big winners, and when the market turned around and when investors decided to book profits, this is where they came first, and look at what happened to the power bar here. 37 bearish or very bearish stocks, only 8 bullish or very bullish stocks. Been an outperformer over the past 6 months, outperforming the S&P 500 by nearly 2%, but that power bar ratio is negative. Everbridge, Coupa, and Box are the names that are indicative of the weakness with very bearish power gauge ratings. And here's Coupa Software. Very bearish stock, weak trend, weak industry. Here's that very bearish rating at the bottom of the screen. Type of name we know we want to look at. And look at how quickly the relative performance has fallen off the map. We're not underperforming just yet, but look at the velocity of this decline. Stock has gone from 80 to 60. Broader market is about 6% off its highs for the S&P 500. This stock is over 20% off of its highs. These are what I'm talking about when I'm talking about the high beta stocks. You heard me last week talk about shifting your positioning a little bit. Look for your long ideas, but look for names with a beta that's less than the market. Stock is currently oversold, so I don't think you sell out of it here. Shaking money flow very bearish under the long-term trend line. Don't really have an earnings catalyst for a couple of months now. I think the way you look at Coupa is if you're long it and you've been riding this trend, any rally that you get over, $65 here in the near term, you use it as an opportunity to get out of the stock. Between 65 and 70, if we become overbought, I think you have an opportunity to open positions on the short side of the coin. Add Coupa, COUP, to a bearish watch list. Taking a look at what moved on Friday. A little bit of a relief rally in the market, and as you can imagine, the names that were hardest hit snap back the hardest as well. Very bearish Netflix, up 5.75%. They are due to report this week. Autodesk was a bearish stock, up 5.5%. Autodesk was on a list of names that Jim Cramer said look interesting on the pullback. So it looks like investors took advantage of that opportunity to bid that up. Intuit and Take-Two also on the list. Activision Blizzard up with Take-Two, right? Both part of the gaming industry group. I would also note that Activision ATVI did catch an upgrade today. On the loser side, PNC, bank stock taken down. Investors didn't like what they heard there. No real news on Freeport FCX to take that stock down over 3% and up tape. GE was initiated by a sell side bank with an underperform rating. Key, no news. Did trigger a sell signal at Chaikin Analytics today, so I would highlight that for you. It is a neutrally rated stock. Sell signal of the relative strength variety. And Huntington Ingalls, HII, down 3% following a downgrade to sell by a sell-side bank on Friday. Our earnings update. Friday was really kind of the kickoff of earnings season. JP Morgan beats by 10 cents. That stock, pretty much unchanged for the volatility we've been seeing in the market. Was down small. Wells Fargo missed by 4 cents. PNC beat by 9 cents, but they were the big loser. That stock was down over 6% on Friday. Citigroup investors like what they had to hear there. That they beat by 8 cents. But what's interesting to me is the bar has been lowered for the banks. Most of these companies jumped over that lower bar, and the bank index was still down 5.7% last week. Now, there was carnage in the market, but that's underperformance, right? The S&P 500 was down 4.1%, and the banks were down 160 basis points more. Underperformance like that indicates to me that there's not strength there, despite lowered expectations. Going to hear from some of the other banks today, in particular the trading-focused banks, right? We heard from Bank of America. We're going to hear from Goldman this week. We're going to hear from Merrill this week. From Morgan Stanley this week. Let's hear what they have to say. And after the close tonight, neutrally rated Schwab will update us. Just a reminder, we suggest caution when you're holding bearish stocks ahead of earnings. So now, turning now to kind of the themes and what I'm talking about in my note today. You've seen this chart a bunch of times. We've been on the right side of this trade. We've kind of backed off of it a little bit lately where we're saying we don't want to press this bet. And this is why. I mean, we're nearing relative support. IWM relative to SPY kind of nearing the lows from earlier this year. And what's interesting to me is we're actually getting close to a support zone on an absolute basis as well. This is the IWM absolute. 150 to 152 is a support zone by my work. So continue to not want to press that bet of being, short the IWM versus the SPY or skewing all of our bets towards large cap at the absolute expense of small cap. I think if you can find some small cap names with strong ratings that have become oversold but are still towards the lower end of the beta spectrum, it might be an opportunity to do some work there, especially if the S&P 500 holds that key 2710 to 2720 level that we've been talking about. 10-year yield holding above the breakout level. Here's the TNX. Key breakout level currently is 3.1%. We are holding above it despite a pullback. For me, really, the key breakout level was when we got above 2.6 here. That set the path in motion to be higher. Path of least resistance is higher for yields. I think as long as we do that in a gradual manner, the market can withstand it. It was the big rip 2 weeks ago when we were up 18 basis points in a week that really caught the market off guard and led to the sell-off in the high-growth names. You can see the RSI here shifting into bullish ranges. Continue to feel that the path of least resistance is higher for yields. We're above the 50-day moving average. We're above the 200-day moving average. And I have to wonder, how long can utilities sustain their outperformance if yields continue to move higher? And here's kind of the big theme for us. Earlier last week, we switched our tone from, full-on bullish to bullish with a bit of more caution. And we think that that's the prudent stance for investors here. And one of the ways that you can look at that and what's driving this view is that this is the high beta versus low volatility ETFs. And you can see after high beta was outperforming for a while, it has subsequently rolled over, broken support, and now high beta is underperforming low volatility. And we are below the 200-day moving average for the ratio. The ratio is beginning to ever so slightly inch higher. In the meantime, the RSI has put in a series of lower highs and appears to be in the process of shifting to bearish ranges. If we're above 2710, we think that the bullish structure of the market is in place. However, how you position yourself within that bullish structure matters. And we think just given some of the volatility that we're seeing now, it makes sense to skew your long ideas towards names that have a lower beta than the overall market. You maintain upside exposure, but if we get another downdraft, you should, in theory, be down less than the market. So you can sign up to get daily stock ideas for free, shakenanalytics.com/powerfeed/today to get the power feed email to follow along with this show. And if you like what you're hearing here, help us spread the word. Share our link on social media, Facebook, Twitter, Google+, which has actually been shut down at this point. Hope everybody has a great day. We'll see you tomorrow.